Hello, everyone, and welcome to another great episode of the Jason Howell Company Speaker Series Zoominars. My name is Jason Howell. Today's topic, the future of portfolio diversification. Now, ever since 2022, I've been having the same conversations with fellow financial advisors, investors, allocators. How can we design portfolios with different investments that do different things when the market goes up or when the market goes down, especially then? How can we create strategies that actually are different from what the market is doing? Well, to answer those questions and a few more, we've got a great guest. Jason Barsema is president and co-founder of Halo Investments, Inc. out of Chicago, Illinois. He's built a career answering these questions for real-life investors, and he has a unique perspective that he's now pouring through to Halo Investments. Before we ask him a bunch of questions, let's just get to meet Jason. Jason, welcome to the Zoominar. How has your day been so far?
It's been great, Jason. Thank you so much for having me. And 72 degrees in Chicago is always a good day for us who live here, especially in October.
I imagine it is. Everything we hear about Chicago is how cold it can get. And so if it's not extremely cold,
Well, it's
then
already busy enough. So let's keep that that thought process of it's too cold. You don't want to be here. But as you can see outside my window, it's quite lovely.
I can't see that outside your window. All right, we're gonna enjoy where we are today and forget about what it'll be a month from now. It's not too bad out here in DC
Exactly.
either. Well, I'm going to go ahead and share my screen and get us to some of the Q&A that I think a lot of people are trying to wrap their minds around just generally. Well, folks, if you've come to the future of portfolio diversification, you came to the right conversation. Before we get to the Q&A, let's just get a word from our sponsor. So our sponsor today is Jason Howell Company. We're a family wealth management firm specializing in sustainable investing and family governance. We're able to compete with some of the most well-known private bank and wealth advisors by forming a virtual family office with a team of experts and specialists. Experts and specialists like Jason Barsema. We are based in Northern Virginia, just outside of Washington, D.C., but we serve clients nationwide. For more about Jason Howell Company, just go to jasonhowell.com. And with that, let's get to know Jason Barsema, the other Jason, a little bit better. So, Jason, what I've noticed about your background is that it's quite straightforward. Basically, two jobs. It seems like you've known what you wanted to do from the very beginning. Tell us a little bit about that. And by the way, tell us how to pronounce Credit Suisse.
Well, it depends on where you're at in the world. And so if you're in America, it is Credit Suisse. Ironically, if you're in Zurich, it's Credit Suisse. So we thought we were being really fancy in America by highlighting the Swiss, but in fact, we got it backwards. But regardless, it was a great bank. Obviously, was merged with UBS last year. And to your point, simple but also loyal is my background and my resume. I have only worked at two companies, one of which is my own. And ultimately, when I started at Credit Suisse, I chose the firm because of the different aspects the bank provided me in regards to learning opportunities. Credit Suisse is a global investment bank that's got investment banking services, so sell side. It's got private banking, which is buy side, working with individual clients, and then it has asset management of managing funds. And to your point, Jason, I've always known what I've wanted to do. I was taught at a young age of find what your passion is and find what you're good at, which is a shame because I have a passion for golf, but I would never be a professional golfer. But I also have a passion for finance, and I'm good at it. I'm not good at a lot of different things, but I am good at finance in the markets. And what really gravitated me towards Credit Suisse and private banking was my passion to help and to serve. And so I got into private banking, not just to invest, but as really to help wealthy families create more wealth and ultimately be able to give that wealth as the majority of the donations in this country and foundations and other charitable organizations are funded by wealthy individuals. That was really, my prerogative was to serve and help grow that wealth so they could give. Ultimately, that was my prerogative of starting Halo, of serving in a different way, which is providing access to a product to people who never had access to it, which is called a structured note, and ultimately give downside investment protection to the people who need it the most, like the firefighters, the teachers, the police officers, the nurses. And so, I guess if you sum it all up, I love to serve. I'm a servant leader. There was a book that I recently, or that my dad recommended to me when I was at Credit Suisse, called Halftime: From Success to Significance. And it was about, what are you doing after you've become successful, right? How is the world going to remember you by? And that really had a profound impact on my life about what was I doing with my life. And I could make the wealthy wealthier, or I could go and try to help everybody, right? And that's ultimately what I chose to do and what my passion is.
Wow. You don't often hear about people going into investment banking to serve, to help people. It sounds like you went there as almost like, a multi-year internship about how to manage wealth and learn wealth and then find a way to give it away in the future.
That's right.
Oh,
Yeah, no, that's right.
that's excellent. And the last time we spoke, I think you were reading a book, Wealth, War, and Wisdom. So you're quite the reader.
Yes, well, it's important to read, and especially I love that book because it's a perfect marriage of economics and history for those who like economics and history. And ultimately, what it does is it takes every point during World War II and analyzes the performance of equity markets and bond markets country by country that was involved in World War II,
Wow.
and basically month by month. And it's really a fascinating read to see how different equity markets performed, how different bond markets performed, and ultimately how smart the stock market is. And that's kind of Barton Bigg's punchline is Mr. Market knows a lot more about what markets are going to do, what history is going to unfold just by looking at the stock market prior to even us as individuals. So it was one of the most interesting reads I've had in a really long time. But Halftime is very different. It's about creating a legacy that's more important and bigger than yourself, where Barton is really about more economics and history.
Speaking about working on things bigger than yourself, tell us about your involvement with the Springboard Foundation.
Yeah, thank you for asking. Springboard is a local foundation here in Chicago where we serve the needs of inner city youth, targeting kids, if you will, that are 16 years and younger. And it's about investing in different community centers and organizations that are started by really, really impactful and ambitious people here in Chicago that want to bring a center of education and play and ultimately growth to these kids in the west side of Chicago and the south side of Chicago that don't have a place to turn to. And so it's a really, really nice organization that invests in our youth, try to give them a future, but also ultimately hold these organizations accountable too, because we help them from a finance perspective, how to manage a budget, how to grow, how to raise more capital so they can ultimately outgrow the capital that we give them as individuals. And I would say the last thing is it's not just about committing financial capital, it's really about committing intellectual capital. So we help not only the organizations, but the students themselves understand finance, economics, business, how to run a company, how to start a company. And it's been really profound. And so, there was a show called Chicagoland on CNN where a handful of our organizations were actually featured on that show. And so I appreciate you mentioning it.
Yeah, it's like junior achievement on steroids. Awesome.
Well,
Awesome.
again, it takes a village, right? And so, if you want to be able to stand up and do something that's bigger than yourself and serve others, then there's no time like today to do so. And this is my way.
Absolutely. Well, thank you for sharing that. I'm glad more people can hear about the Springboard Foundation. Let's get to our Q&A. Portfolio diversification. I think the easiest thing and the easiest place to start would just be to ask you, how do you define a diversified portfolio?
Well, it's a great question because you'll get a different answer from probably any unique individual that you interview, right? And what I find really fascinating about how we traditionally define diversification is about building an optimal portfolio that sits on an efficient frontier, right? Really, this Markowitz model. And we always talk about Markowitz, but what we don't really understand, right, is that this model was created in the early 1950s, won a Nobel Prize. So, it was very
Good stuff, right?
yeah, it was great stuff, right? But it was 70 years ago. The world has
Right.
changed over the 70 years. And what's interesting about Markowitz is that it's really just building this efficient portfolio based on risk and return. But the problem is it doesn't think about the other factors within our portfolios that ultimately we value as individuals, right? On a day-to-day needs basis. And what do I mean by that is what about liquidity within the portfolio? What about the volatility that you can withstand? What about the growth that you need? What about the income that you need to generate? And so it's really about developing this radar graph of 5 different points on this radar graph or star graph, whatever you want to call it, because there's different trade-offs that have each one of those points, right? And so I may be able to build you the most efficient portfolio in the world, but it might not be liquid until 5 to 7 years from now. That probably doesn't serve the needs of the vast majority of people who are investing, right? And so we really need to take into account the importance of liquidity, how much risk that we can tolerate, how much growth that we want to have in the portfolio, and ultimately how much downside investment protection and income that we would like to have to be able to make rational decisions, not just from the investment advisor perspective, but also from the client perspective, which is why I always call this kind of the third dimensional investing, where traditional investing has always been this 60/40 portfolio of stocks and bonds, right? It's this 2D pie graph. And I always used to educate, younger financial advisors at Credit Suisse, and even my own clients is let's take portfolios in the third dimension, right? Putting this halo, hence our name of halo,
Nice.
around portfolios to provide that comfort of a cushion and offering that defined level of protection to protect us against the unforeseen, right? And that's the next generation of diversification, is protecting the unforeseen. And the last thing I'll say about this, right, is how did this traditional 60/40 portfolio do during the tech wreck? How did it do during 2008 and 2009? How did it do during March of 2020? How did it do as recently as 2022? A fully diversified portfolio was down around 20% just
Didn't
2 years
work.
ago.
Didn't
Right,
work.
because when correlations go to one, correlations go to one, meaning everything gets thrown out with the bathwater. And ultimately, it's like the 60/40 equity bond portfolio is like having, this rain insurance against a hurricane. It's good, as I have a lot of family that lives in Florida, and I'm wishing them all the best right now. And hopefully everything works out for the entire state of Florida. You're in my prayers.
That's right.
But ultimately, as they're dealing with their own insurance, yeah, it's great against a rainstorm. But then when the hurricane comes, it goes away. And that's how I feel about the 60/40 portfolio. When I need that portfolio insurance the most, it fails me. And that's why I started going to this third dimension of getting defined protection in the portfolio to provide true diversification against that hurricane, because that's the whole point of diversification.
You mentioned a couple of seasons we've had in the world, but more specifically the market. What do you see from these, areas, these times of extreme volatility, 2009, 2020, 2022? What are you seeing that sort of changed the way we look at diversification today?
Well, I think about things in a very simple way. And so I encourage everyone to do the same, right? And when I think about portfolio management, there's only 3 things you need to do in your portfolio. You need to grow your wealth, you need to preserve your wealth, and you need to generate a level of income. Outside of trust, estate, and tax planning, which is separate, from a portfolio management side, that's the only thing you need to do. And as financial advisors, we tend to overcomplicate it. And we tend to overcomplicate it because we maybe want to show off for a client or a prospect. We think finance needs to be harder than it actually is. And I feel like ultimately those 3 goals have always been the goals of all investors since the beginning of time. We just want to grow our wealth at a reasonable rate. We want to preserve our wealth because, again, we work hard for it. And then ultimately, we need to generate some income to pay the bills, pay the taxes, and buy some fun things, right?
Yeah.
And so I think now is ultimately this is the beauty of technology, is not that we've never not wanted this in the past. We've just never had tools to be able to accomplish these goals within our portfolio.
Wow.
And that's the beauty and the elegance of structured notes and other protective investing products, is now they can through technology. Where before you could only access these products at a private bank like a Credit Suisse, like a Goldman, like a Morgan Stanley. When I was at Credit Suisse, which was not that long ago, you needed $1 million to buy one product. Most people can't afford $1 million to buy one product,
No.
right? The median savings rate in this country is roughly $70,000 going into retirement, right? And so,
I've heard less actually, so it just
yeah,
depends on the
and
stats.
exactly. And so technology ultimately can democratize things, right? Just like as Google democratized information back in the 90s, Halo and other platforms are democratizing investments. We've democratized structured products. There's other companies that have democratized other types of products. But now these really important diversifiers, this really important insurance within your portfolio is available to all. I think that's step number one. Step number two is our country is getting older, right? From a demographics perspective, our country is getting older. And if we're getting older and we have insufficient savings, what do we do, right? Like if I'm getting older and I have insufficient savings, I have to work longer. And now add on top of the inflation that we've been dealing with and the historically low interest rate environment that we've dealt with for over the last 25 years, we are naturally forced to take more risk in the portfolios because we have no other choice. It's not because we want to be riverboat gamblers. We've got no other choice, right? Like we can't afford to work or retire, I should say, at 65 years old. Now we have to work maybe another 5 to 10 years, right? We can't afford to put food on our table or a roof over our head anymore. And that is why you see the sign of impact before profit, is because I had tools as a family and as a private banker that most people didn't, and that's not equitable. And so that's where we ultimately, I think, provide our impact as a company. And then you start thinking about the role of diversification and the rise in the demand of these types of products, is because if we're forced to take more risk by investing more in stocks, because bonds aren't giving us the yields and the payout that we need. So if we're going to go more into stocks, let's do it with protection, right? If you're going to drive a car 200 miles an hour, let's do it with insurance and airbags, right? And that's how I feel with investing.
Well, we'll do that for us. I mean, list for us a few examples of protective investments, and then let's talk about structured notes and really what are they?
Yeah, and I'll kind of combine those two questions, right?
Yeah.
Is yeah, I've been buying structured notes for a very long time. They're about 25% of my personal portfolio. They were 20% of my portfolios at Credit Suisse on average. And ultimately, what I did was that I would take 30% of my equity exposure and I would allocate it to a structured note. So if you looked at a total portfolio view, that was around 20% of the total portfolio. If you just look at the equity sleeve, it was about 30%. And
Okay.
I would do that within every sub-asset class within my equities. So what does that mean? A sub-asset class would be US large cap core, large cap value, large cap growth, small cap, international developed, emerging markets. Those are sub-asset classes within your equity sleeve. And so what I would do is that I would take 30% to a growth note, a growth oriented structure note that gave me upside on an asset and downside investment protection, which I'll get to in a second. And I would layer that right on top of my long equity. Why? I consider that structured note as just like car insurance, right? Just as like I would never drive a car without insurance, I shouldn't invest without insurance. A Mercedes is a Mercedes, whether you have insurance or not. The S&P is the S&P, whether you have insurance or not. But it's a heck of a lot safer and ultimately makes us feel a lot more comfortable driving or investing, still using my metaphor, to do that with insurance. And
Hmm.
so, case in point is I bought a growth oriented structured note on August 5th when the VIX spiked to 65. And we were near correction territory at that time. And I bought a 5 year structure. So, all structured notes have a maturity date, just like a bond or a certificate of deposit. Structured notes have a maturity date. It could be from 6 months to 10 years. You pick it. I chose 5 years because it's a core part of my portfolio. I'm fine holding that holding that note for 5 years. And so it's a 5 year note linked to the performance of the S&P 500. Just like when you buy SPY, it's linked to the performance of the S&P 500. When you buy a structured note, it's linked to the performance of an asset. In this particular case, it was the S&P 500, right? It gives you that exposure.
Right.
And this note gave me 30% downside investment protection when we were down already nearly 10% off the highs. So I really like that because it also gave me the confidence to get invested because I had no clue of where the market was going, right? Like, is it going to fall another 10? Is it going to rally?
Right.
Who knows with all the macro variables. So I love structured notes because they help protect me, but they also help me get invested. So this note had 30% downside protection. And at maturity, it gave me nearly 200% uncapped upside on the S&P. So what does that mean? In 5 years, if the S&P was up 50, I'm up 100. If the S&P was up 100, I'm up 200, which is like obviously a lot better than buying SPY.
Of
naturally.
course. Of
But
course.
but now, ultimately, the trade-off for me is that I have a call feature on this note. And what is a call feature? Ultimately, that means in 1 year, my note is up for call. Meaning if the S&P 500 is up a penny in 1 year, my note gets called, I get my investment back, and I get a 9% return on this particular investment. So that was kind of my risk or my trade-off. To get that 200% uncapped upside, I'm risking that my note could get called a year earlier. And the way I looked at or get called after 1 year, and the way I looked at it was like, well, geez, if I make 9% after a 1 year time horizon, I'm feeling pretty good. The historical average of the S&P is 8.5.
Right.
And so I don't want to overcomplicate things, but think about it in the sense of if you only own SPY, you get all the joy of the upside, but you take all the pain of the losses. By taking 30% of that exposure and layering it right on top, I get to mitigate those losses with the protection I have from the structured note. And the cherry on top is that I can get 2-for-1 upside, outperforming my SPY exposure, right? So that is really the power of these protective investing. That's what I led with at Credit Suisse when I brought in new prospects. That's ultimately what built my business. And I very quickly went from what is a structured note to why would I ever own SPY when I can buy this product? And candidly, it was a good question, but there is a number of reasons why you still want to own your long equity.
Now, what was challenging for me when I first learned about this isn't insurance. And so it's something. And to the people that are watching or listening, of course, it sounds wonderful, maybe too good to be true. But the thing that pierces that is exactly like what are they? What is it? If it isn't insurance, what's creating that upside? What's creating that opportunity to escape the downside when it comes to structured notes?
It's a great question. So when you kind of look under the proverbial hood, what is a structured note? Ultimately, a structured note is a candy wrapper of two assets. So 85% of a structured note is a bond, and the other 15% of a structured note is an option. That's it. It's just an option matched with a bond to give you that payoff. The types of options that are used are all dependent on what type of protection that you have and what type of structured note that you have. There's a lot of different variables, which again is what I think is the elegance of the product, is they can really marry exactly what you want to achieve in the portfolio. You only want to generate income? Awesome. There's structured notes that generate income. You only want growth? Great. There's structured notes that give you growth. You want to focus more on downside protection? Great. You can do that too. So when you look under the hood, a structured note is a bond and it's an option. Who
Okay.
manufactures this product? It's a big bank, like a JP Morgan, like a Morgan Stanley, like a Citigroup, like a Goldman Sachs. And so that's what we do is we ultimately pair or bring all of these big banks who issue these products via technology to financial advisors like you, Jason, where you can analyze, get educated, research, and ultimately buy and manage your structured notes all with a click of a button. And that's kind of the elegance of technology. But hopefully that answers your question of what is a structured note when you look under the hood.
Yeah, it sounds like there's a bond and then there are options. So people have heard of trading options before. There's someone at these big banks that are trading options on these bonds, and Halo Investments partners with them and exposes those opportunities to financial advisors like myself, who then can pass it along to clients.
Yeah, that's exactly right. Right. And
Yeah,
so you have these big banks that think of them as, um, the auto company, right? They're making the cars and they're manufacturing the cars. And Halo ultimately is the platform, like a Carvana, if you will, to
sure.
deliver those cars to the masses. So instead of needing $1 million to buy these types of products, you can buy a structured note on our platform for as little as $1,000 now.
Yeah, you've kind of democratized this process. I would say somewhat, but I think very specifically you have as little
Yeah.
as $1,000 for some of these investments, or you can have a higher minimum and kind of create your own. I mean, speak to that a little bit, the second to last question here, because there are more than Halo as far as firms that offer this, but how has Halo Investments been on the forefront of democratizing these protective investments?
Well, I think number one, it's about education. So forget about the technology for a second. As I told you, I got into private banking because I love to teach, I love to help, I love to serve. And so we took a big focus on education. And so, A, it's helping demystify these products because they're not overly complex. It might be new to you, but they've been around since the 70s. But ultimately, I always say the complex of today is the vanilla of tomorrow. How does it
Mm.
become the vanilla of tomorrow? It's through education. So there's a variety of different research and content that we put on our platform, analytics to help advisors or be fiduciaries so you can make more informed investment decisions. Then ultimately, we have a team behind the technology that serves the needs of our advisors to ensure that the products that they're buying are suitable for the investment objectives that they're trying to achieve. So I like to say it starts with the education and the people to help bring to light the beauty and the elegance of these products. Then number two, it does come down to the technology, right? So if you look at how structured notes were manufactured before Halo, using my car analogy, it was like how cars were manufactured before Henry Ford's assembly line. Super
Right.
time intensive, cost intensive, human intensive. So what my technology does is ultimately automate that manufacturing process that allows the minimums to be reduced by so much. And then we digitally connect them via marketplace where advisors can go on and analyze, research, and purchase and manage these products. What makes Halo unique from other providers out there is that we have the technology, right? Our technology puts all of these banks in competition to ensure that you're getting best price. Our technology focuses on analytics so you know the right product to actually put in your portfolio and manage your product. Our technology also gives you the liquidity so you could sell these products on any given day prior to the maturity date. So that's just one small sample of what our technology has done to ultimately reduce the fees, increase transparency, increase liquidity, give you choice, and ultimately give you a better buying experience, right? You got to make it easy to buy. Back in my day at Credit Suisse, it would take you hours to get a price
Oh, wow.
and days to execute a product. And Jason, as you can relate to, we've condensed that quite considerably.
Yes, you have. It's been a really good partnership over the past couple of years. Spent a lot of time
Thank you.
talking with one of your staff members, Chloe, who's been a delight and quite educational, and really happy to have learned so much so that I can feel and know that I am still a fiduciary for my clients because I'm really understanding something vis-a-vis some of the education you provided. So thank you for that.
Oh, well, it's our pleasure. I believe in the growth of this industry, and I believe we're in the early innings of that growth, right? And so, and you've seen that through not only the growth of Halo, but just the growth of the industry as a whole. We were recently named the top 10 world's most innovative companies, and that's great. But ultimately, if you look at the market for structured notes, it's been the second fastest growing asset class behind alternative investments in America over the last 5 years. And I think it goes back to all the reasons that we talked about before, right? Is that
Yes.
structured notes protect us from the market, but they also protect us from ourselves. And I think that that's really important so we can be clear-minded when we're making rational investment decisions, especially under times of duress.
And it sounds to me like this last question, you see a marketed growth over the next number of years between, alternative investments, and some people put structured notes in that bucket as well, but essentially different ways to diversify your portfolio.
That's right. Alternatives are different than structured notes. As I go back to the note that I bought, right? S&P exposure is S&P exposure. That's US large cap core within my portfolio. It's just got a level of protection on the downside, right? Where my alternatives are more my private equity, my hedge funds, my commodities, my real estate, non-correlated assets. Now, my problem with hedge funds and private equity is that it's kind of that hope and pray approach. Like
Mm,
when the market does really bad, oh gosh, I hope my manager is doing their job that I'm paying them 2 and 20 for, right? And then I'm getting zero liquidity for. And
right.
that's why I've really shifted more towards the structured note side, especially over hedge funds, is because it gives me that defined protection versus that hope and pray protection. Now, when you look at the market, it's not just me saying this. When I founded Halo back in 2015, this country was buying $40 billion a year in structured notes, which is a lot, right? Like it's the biggest market most people have never heard of.
Yeah.
However, if you look at last year, this country bought 120 billion. So the market has increased by a factor of 3x, and you're like, oh, geez, is there still more room to grow? Absolutely, because most people have never heard of this product. And when you look at Europe, they buy $400 billion a year in structured notes. Even more, Asia buys $650 billion a year in these products. So I firmly believe, given demographics, given inflation, given the increased risk we're forced to take in our portfolio, and the need for more diversification tools, given all the macro uncertainties out there, I believe when we're in our very, very early stages, and this is the new renaissance of this protective investing, most of us would be willing to accept 75% of the upside to only realize 50% or so of the downside, right? I think that
Right.
that would be a fair
Yeah,
statement.
interesting trade. Yeah.
And that's what structured notes do, right? And I think that's the future of wealth management is this defined outcome investing, this protective investing, and ultimately personalized investing. And that's what you get with Halo. We give you 3 billion combinations, probably too many combinations, Jason, as you can relate to,
I try to
right?
keep it simple because I only do the stuff that I
Me too.
understand, but
Me
there
too.
is more out there. I'm gonna stop the share and just go to our big faces. I was listening to Mark Rowan of Apollo a couple of weeks ago, and one of the things that stood out to me from his thinking around private credit, for example, is talking to investors about risk per unit of return. You know,
Yep.
that idea, and it sounds like you're
And per
espousing.
unit of liquidity, I think
Oh,
is
that's
really
another great
important.
point. That's another great point. And so, thinking about investing a little differently than maybe Harry Markowitz from the 1950s is something that's incumbent upon advisors and perhaps even individual investors. Though, as I understand it, individual investors don't have as much access without an advisor for example, structured notes. Is that right?
That's right. And so if you want to buy a structured note as an individual, contact your financial advisor and have them go to haloinvesting.com to learn more. If you don't have a financial advisor, Jason is a great one.
Hey,
But all seriousness, right? Financial advisors play a really big role. 50% of this country manages their own money, right? And ultimately, I think the reason why financial advisors play a really important role is not because, no offense, that they provide you optimal returns and they're going to give you these blowout returns. I'll just speak for myself. I
sure.
wasn't that I wasn't that good.
Hard
While
to
my
compete at that level. That's
Yeah,
true.
why my clients hired me was because I was a really good psychologist, right? And I was a really good listener. And again, when we get scared, we make irrational decisions. And when we make irrational decisions, that's the worst thing that we can do in our portfolio because it usually leads us to sell low and buy high when it should be the other way around. And that's what I say for the third time. That's what I loved about structured notes. It gave me the confidence to stay invested, but just as it did back in August, it gave me the confidence to get invested because I knew I had the protection, right? And so I'm a big proponent of financial advisors because they help educate you on that psychology, plus the important tangential aspects of tax planning, retirement planning, and ultimately generational wealth planning.
Before we go, whether it's advisors or individual investors, what's really one takeaway that people should have from this conversation around portfolio diversification in the future? What should be their next step in thinking?
I think it's about understanding really that radar graph that I was telling you about. Don't think just about risk and reward. Those are two very important things. Think about your liquidity needs, think about your growth objectives, think about your income objectives within your portfolio, right? And then take a look at your portfolio and think about your portfolio under these stress circumstances, like 2022, like during COVID, like during the GFC, and think about how you felt. And they always say the pain of losses outweigh the joy of gains 2-1. And I think that they're right. So ultimately, when you start thinking about that, think about what tools like structured notes you can use in your portfolio and think about how they can really supercharge that protection within your portfolio. And yes, the upside 2-for-1 sounds great, and it is. God bless. But I buy it for the protection because it helps me sleep better at night. And the last thing I'll leave you, one of the leading causes of stress, death, divorce, and suicide in this country, with a suicide rate at the highest it's been in American history for people over the age of 65, is financial related.
Wow.
And this is the United States of America, right? Where I think we've had pretty good economic times.
Pretty good.
And we have it relatively good financially in this country. Think about that. That's profound. And no one should ever, ever take their life because of financial stress, right? And that's my mission of ultimately what we do and why I live what I preach of impact before profit is because there are tools out there that can help you sleep more at night while grow your wealth at a reasonable rate of return. And that's what I aim to do.
I appreciate that. And as you mentioned that, I think it's always incumbent of us to say if you are considering thoughts of suicide, to check out the suicide hotline and speak to someone that can walk you back a little bit. Jason Barsema, co-founder, president of Halo Investments. Thank you for the education. Thank you for, in some ways, the inspiration to look at things a little differently.
Very passionately.
Yeah, you are. And continued success, both with your business and, of course, with the impact you're making in the communities that you serve.
Thank you so much for having me, Jason, and thank you for your partnership.